Hi everyone, just wanted to make this quick video about, I'm not sure how quick it's going to be, but I want to make this video about the two conferences I've been to in Las Vegas and now in Scottsdale, real estate conferences, mainly focused on multifamily. So just wanted to make a video about what I learned, from interviewing many expert speakers and attendees about what's happening with the market, what's happening with the debt environment, and overall economy and what investors are thinking and what they're planning. So, so yeah, I mean, the Vegas conference was great. It was a smaller conference, around 200 people, so it was very intimate. And when I get a chance to interview these expert guests, guest speakers, it's really they're put on the spot, right? So all that information is, this is not rehearsed. They haven't planned for it. I just see them at a conference and I pull them aside. So a lot of that content and information is really candid. It's really coming right straight up from their brain. So we're getting I'm getting access to the inner workings of their brain and what they're thinking about the current market and economy. So as much as people are still very bullish on the market and hoorah, go go go, there is definitely some fears and concerns about where the market is heading. Again, I've repeated this so many times, but we're still in an increasing interest rate environment. Imagine buying an asset that the interest rates is one of the most important components of it. Now, I know you can get fixed debt and you can get, you know, um, interest rate cap, which is an insurance policy on your interest rate. But overall, when you're in such an environment, real estate has a direct um, uh, connection to interest rates. Interest rates go up, real estate prices actually come down. It's just a matter of fact. So you could see the concern in many sponsors and operators and expert, speakers that I was interviewing. Um, so that's, it's just an unavoidable fact that we're still in a, increasing interest rate environment. Another great thing about Las Vegas and Phoenix or Scottsdale is they got a pretty decent cigar smoking community. So pretty easy chance to get your hands on cigars and be able to be surrounded by others who smoke. But anyways, I'm digressing. Coming back to real estate. So real estate is such a broad ecosystem that it's difficult to say, hey, how's the real estate market doing? So it depends what market is. Asking that question is like asking, how's the weather doing? The weather where? Um, you know, so in our space, commercial real estate, which encompasses all these different asset classes, multifamily, industrial, office space, um, and retail, hospitality. Each one of them is in a different type of cycle, but all of them are in the potential recession cycle, right? Overall, sponsors are pretty concerned as far as where the rates are going. There's still a lot of unknowns there, um, and rents as well, right? A lot of layoffs are happening. We're in a potentially going into recession. I believe we're already in a recession. So that's another concern. Um, but yeah, the overall feedback was you could feel the potential anxiety, and a lot of people who are bullish and the cheerleaders of real estate and buy all the time. There's always deals. Okay, fair enough. There's always opportunities. I agree with that. If the numbers make sense, you can buy real estate in any environment. But right now is just a time that because there's so many unknowns still, um, it's a difficult time to to get into real estate because of the unknowns. And you also have when you talk about real estate private equity or syndications, you also have the factor of the equity, and equity is much more emotional compared to debt. Debt is much more logical, right? Debt is straightforward, is math, whereas equity is emotions. So the equity markets and equity capital markets, particularly equity markets, have been extremely tight. You're dealing with mainly retail investors in our space. So as soon as they see things on TV, they see things on the news about the real estate market, so they get super concerned. So a lot of operators are having a really difficult time raising equity for their deals. So that's another thing that's obvious. When you see a certain sponsor whose deal got oversubscribed in a matter of weeks, now it's taking them months, and they're getting the help of multiple GPs to come on board. That just tells you where we are at. Like, I wonder if I was being interviewed and I would be asked, "Is it a right time to get into the market?" And I guess our track record here at CPI, CPI Capital proves my thesis, which is to be extremely cautious. So if you're going to be extremely cautious, it's going to be hard to close on deals, and that's why we haven't, closed on a deal for close to a year now. Um, but overall, long term, I feel very bullish when it comes to the U.S. multifamily market. Long term, 100%. U.S. is becoming more and more renters nation, um, and there will be deals and opportunities, but not the way you think as far as distressed deals coming to the market, because a lot of experts are saying it's not really the deal is not distressed, is the sponsor that's in distress, is the operator that's in distress because of their debt obligations, insurance obligations. That's another elephant in the room, is insurance. Aside from debt, is insurance rates have been going up astronomically, and that's something most people couldn't account for, right? I was talking to a sponsor who's thinking about giving the keys back to the bank, and um, their insurance was at, I think, 700K a year, and now it's gone up to close to $4 million. So imagine that. That's gonna just eat away from your cash flow, and you're gonna be in negative cash flow situation, and that's a bad place to be. Now, both in Texas and Florida, there are some potential government initiatives that are gonna put some restrictions on how much these insurance companies can raise their rates by. But again, that still is not cemented yet. So a lot of volatility, a lot of distress. There's a lot of caveats on multifamily currently, and it's time to be cautious. As far as when is a good time to enter the market, I mean, again, it really depends on the deal, right? Overall, I would say be extra cautious. But if you're being extra cautious, it's going to be hard to get any deals done, right? Especially if you're syndicating deals. Let's see what else. Did I learn anything interesting? Another very important point is never turning off the engines when it comes to equity, like connecting with investors and creating content and always being out there. So I see a lot of successful groups, they never turn that engine off just because the market is slow and they're not really doing that many deals. They don't just They're still renting their booths at conferences. They're still speaking on stage. They're still connecting with investors. So they never turn off the capital raising engine, and that was something important that I learned. I knew, but it reinstated fact. Um, yeah, we've been at a bunch of conferences. We're gonna go to a few more. We're gonna be in a conference here in Scottsdale next month, and then the multifamily conference in Toronto end of May. Excited about that. We're gonna be launching our fund. I think it's a great time for a fund now, because the fund then can raise equity and be opportunistic to be able to pull the trigger on deals when time comes in. So you don't have to syndicate it. You can just have a dry powder to enter the market. So excited about our fund. Um, that's about it. Yeah. Leave your comments below. Tell me what you think. And yeah, thank you.